right, joining us now on the desk, Wayne McCurrie, Momentum Asset Management, Chris Hart, Chief Strategist at Investment Solutions, and Waseem Thokan, Economist at Legae Securities. Gentlemen, thanks once again for joining us. Great to have you on the program. Let's start off with you, Wayne. As we said, markets under pressure today. A few exceptions that came through, but nothing really shooting the lights out.
I'm not sure why Rembrandt's fallen so much, but otherwise the bottom of the top 40 really translates, I would think, to two factors: stronger rand and the expensive shares. So like Shoprite down quite a bit, and you can understand some of the mining shares down, weaker rand, and of course Naspers. You know, these were not, wasn't 10 cent, doesn't look all that good there, and this is an expensive share. So Naspers has taken a bit of a caning this week compared to the other shares in the market.
And the revenue didn't hit expectations.
Didn't get quite what you thought. And you know, that's the difference you were talking early on. When you buy Naspers, this is a 36 PE share. You've got to get good news. Whereas if you buy an 8 PE share, you can stand a bit of bad news. The share doesn't fall too much.
And the 8 PE shares, Chris, of course, sitting in the resource space. Are you brave enough to delve into this? And maybe the gold stocks, I would expect.
As you say, I'm always game for that. But the resources do look, they really do look cheap. But one's got to be careful of resources because of the stage of where earnings are. One needs to put the question: if Tencent is struggling and China is struggling, and that's a reflection of China, I'm not sure if you need base metals at this point in time. But
But diversified miners, yes.
There's a bit of base metals. I'd prefer, for instance, billet and so over Anglo, because I prefer the energy side that Billiton carries, as opposed to the richer base metals that Anglos carry. But beyond that, when we're looking forward, I think clearly your central banks are saying we're not going to worry about inflation. We're worried about financial stability. We're worried about growth. They're going to be pushing that next year. As we often say, if they worry about inflation, you don't need to worry about it. But when they do not worry about inflation, you do need to worry about it. And that's exactly, I think, where we are.
And their moves are, of course, creating perhaps more inflation.
Yes.
Let's get you involved in coordinated action. Do you think it's going to result in a lot of inflation down the line? Because in a sense, it is a form of quantitative easing, isn't it?
In a sense, it's expansionary, Eleni, but really speaking, it's only the beginning. The liquidity provided was mainly to the banking sector through a euro-dollar swap facility. So what's the real kicker in terms of the possibility of inflation is actual expansion of the ECB balance sheet. We haven't really seen that come to the fore yet, although I was reading today that there was a rumor out that Mr. Draghi and co had agreed to a facility for the IMF to the tune of about 200 billion euros to come to the fore in terms of supporting Italian and Spanish bond yields through the facility of the ECB balance sheet and the IMF. I'm not sure if that's really sufficient, given that, I mean, if you look at the ECB security market program that they've done so far, they've done over 200 billion euros of purchases in peripheral bond yields, and that hasn't really subdued the market. The yield spikes have still been as
Chris, I can see you want to also interject there. You don't agree?
No, I agree, but we need to also say that the Germans are determined that fiscal balances get rectified through cutting spending. In other words, we're going to still see huge amount of fiscal drag. The European Central Bank, to a large extent, has become isolated. It's not that the market is not aligning with the European Central Bank by saying, okay, if they're buying Italian and Spanish bonds, we won't at least sell. They're saying, you can have mine, and they are still selling. Okay, now this week we've seen a bit of a pullback of that, but we're also in a sense seeing the Federal Reserve being a little bit isolated with their Operation Twist. They're busy buying the longer end, and they are basically buying into selling there, and that means they're also a little bit isolated, and that means quantitative easing is busy expanding in quite a big way. And that's
so money supply expanding in a big way, which could result in inflation.
That's effectively narrow money, and we can see that the US money supply growth is over 20% now. If that doesn't translate into growth, we will see it in inflation.
Stagflation then.
Yeah, look, whenever you print money, it's never good news. You're just not sure what it's going to end up in.
Liquidity
And that's
kills all evils.
Short term sorts out every single problem short term. but it's got tremendous long-term implications. And I can't see how this doesn't end up in inflation somewhere. But of course, you won't see a sign of it for a long time, because the world essentially is in a deflationary environment. And in a deflationary environment, you can print a lot of money before it starts to become a problem. But very simplistically, there's no such thing as a free lunch. You can't just print money and not face some sort of consequence, whether it's asset price inflation, consumer price inflation, massively weak currency. Something has to give. But it does sort out short-term problems.
This is where I always say they're not really dealing with the problem, right? They're basically quantitative easing to monetization. It doesn't really matter. You're transferring wealth, you're destroying wealth, you're not actually creating wealth.
Do you think that they're dealing with to deal with the problem, austerity measures coupled with taking the pain right now? That's dealing with the problem, and that's dire.
Absolutely, Eleni. Remember that I do disagree somewhat with your other guests, given that money velocity in the Eurozone is absolutely rock bottom, given that they're slipping into a recession. So the fact that the money supply is actually increasing doesn't necessarily feed through to inflation, at least not immediately. Now, the consequences of not coming to the fore with a support program for Italy and Spain would be pretty much potentially disastrous for the euro currency as a whole. So it's really the lesser of two evils that they expand the balance sheet to this degree.
Yeah, inflation is over 3% in the Eurozone. I don't think that's completely benign, especially where you see where inflation is, and that was generated with the euro at over 140. It's now close to 130. There's a weaker currency. That does not mean inflation will necessarily be benign or just simply go away.
Which of the lesser evils do you evil do you prefer?
I suppose you can make it very simple. You can call it tough love. Now, in the old days, let's say in the 70s and that, if a country was going to go to the wall, or the 80s, the country went to the wall. People didn't worry about it. They said, well, you got yourself in this trouble. We're not bailing you out. You must sort it out. Whereas now they're saying, look, the consequences of allowing countries or companies or banks to go to the wall.
But it's more a globalized environment, though, and
yeah, but look, there are still very isolated countries that have got themselves into these big debt situations, and the banks, by buying their bonds, have also got themselves into trouble by doing it. But I think Waseem's right. It's the lesser of two evils, because quite frankly, if the world had to collapse and the euro had to collapse and a few big European banks had to collapse, we actually don't know what the outcome would have been. We just don't know. So it's probably best not to take that punt. But it doesn't sort the problems out. I mean, make no mistake, this does not sort the problem out. The problem is going to take a decade or two to actually get sorted.
In my mind, we just land up with bigger and bigger problems, and eventually we can't even kick that can down the road with liquidity.
To wrap things up, let's touch on South Africa. 1.4% growth for the third quarter. Waseem, your view on where South Africa is headed from a growth perspective?
Yes, Eleni, the 1.4% print was a little bit disappointing. Remember, there were some disruptions to the supply side environment, especially around the strike season in the manufacturing and the mining sector. That should work its way out of the numbers. You see that in the high frequency data around manufacturing in the fourth quarter so far. That should kind of continue going to the end of the year. So the end of the year should see a slight tick up in growth, but the long-term environment's not looking very optimistic. The survey data and the leading indicator especially is not showing very much optimism at all.
No, exactly. The leading indicator suggests stagnation at best.
Fantastic, gentlemen. We have to leave it there. Great to have you on the program.